Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different ratios. So I'm going to compare an ETF to another ETF. The first one will describe kind of how this works, when an asset's cheap, when an asset is expensive, when you want to be looking at potential investments and whatnot, and where we could see potential outperformance of particular ETFs. The ETF is more or less a representation of the sector. So that's what I'm using them as. It's not this ETF versus this ETF. I'm using it as a representation of the sector to see how these things perform against each other. And it's a general kind of overview. It's not specific. Like, you can use different ETFs. You can do this with any sort of asset just to see historically where it's been priced. And some of these don't have a whole bunch of data behind it. So it's hard to say if something's cheap or expensive with only a few years worth of data. So keep that in mind as well. I'm going to jump in here. I'm going to give you my financial opinion, and let's dive in. So we're going to look at a whole bunch of different ETFs. I've got URNM versus a lot of different ETFs. We're going to try to find what the cheapest sectors are at this moment and what looks good and what looks bad. So looking at the first one, we've got the numerator, which is the top one, and then the denominator, which is the bottom. URNM is cheap. The numerator's cheap when you draw a line and it's above here. I said that backwards. XLE is cheap when it's high. URNM is expensive when it's high. And when you're down low, like down here, URNM is cheap and XLE is expensive. So that's how you want to look at this. And I'll let you know what's expensive and what is cheap. So we are kind of in the mid-range for this. We've broken out of this falling wedge to the upside. We did a retest and we're trying to move our way higher. And we came all the way back to basically the support level that we've used for a couple of times. Looking at this, I would favor uranium over XLE at this time, looking at these two ETFs because of the broken wedge pattern to the upside. And I know that we're kind of coming back, but I think eventually it'll work its way higher. It's basically a wash in terms of how expensive or cheap any of these are against each other. URNM versus natural gas. So when these things come down like this, down here, uranium is cheap. At least URNM is to natural gas, the physical commodity. So URNM, I would say, looks favorable in this type of move. I also think uranium could potentially move to the upside even on the shorter term. URNM versus XOP. Yeah, you know me. Broken downtrend, that's what we've got right there. It's slightly cheap for URNM looking at this data set all the way back to 2020. And URNM is looking like it's trying to put in a bottom here right on support. So URNM is looking good to try to break to the upside. We've got a little downtrend line. We can put that in there as well, where we're trying to kind of break through that as well. And once we break through it, we could see a violent move in URNM. Looking at URNM versus platinum, I don't think this is a fair comparison because platinum's just a commodity versus a leveraged ETF. But to me, it looks like URNM could even outperform platinum. We were in this consolidation period, and we've dipped out a little bit below, but it definitely looks like it's trying to break here to the upside where URNM could really start to move. So URNM looks good, even though we dip below this support level. This could be the slingshot type movement where URNM basically beats all these different assets. We've got URNM versus the NASDAQ, NDQ. And again, this has been an outperformance of URNM the entire time. We'll see if we can break to the upside here. I don't know if we're going to get that. This does look like we've got some momentum to the downside where it could come back down there. URNM versus the CRB index. I also think that this looks pretty good for URNM. We've got a consolidation pattern here. Let me get that out of there. I chose the wrong thing. There's your consolidation pattern. So we've broken this falling wedge to the upside, consolidated again, and we're about to break that to the upside. So I think URNM is going to outperform the overall CRB index. Looking at URNM versus OIH. So looking at this, we've had an outperformance of OIH heading lower here. So OIH has been outperforming. We're back down to this nice big support level. And now we're looking to see what happens down here. Is OIH going to take over and break through to the downside, or is URNM going to hit the gas and work its way higher? We don't have a clear direction yet. If I were to guess, URNM looking good against all these other assets. I think URNM has a chance to stick it to a lot of different sectors. So here's URNM versus REMX. This is basically a no-win, no-lose situation. It is ping-ponging between these two levels, and we're in the middle of it. But it does look like URNM wants to beat REMX to the upside. And then URNM versus COPX, we've completed this pattern here. It's probably ready to turn around where URNM will outperform COPX, hopefully shortly. So URNM is a powerhouse. It's looking pretty good. If we switch it up and look at XOP, XOP against REMX, this looks favorable for an XOP performance, potentially. We're coming on up. We hit our head. We came on back, put in an inverted head and shoulders, kind of hit our head again. If we can break out here, I think we've got some room to run to the upside. If we look at it from a big picture view, there's definitely room up here before we top out where XOP could outperform REMX. We also have what could be a potential shoulder, head, shoulder that's going to develop. And on the big long term, we could see XOP do really well here. XOP versus MOO. MOO is the agribusiness ETF. I think this looks good for an outperformance of XOP. So we've got this long kind of descending wedge pattern that broke to the upside. XOP looks really good for a move higher against MOO. We were at very high levels. So XOP can move dramatically against it to the upside. XOP versus OIH. OIH is incredibly cheap. Obviously, we're still in this uptrend. I can kind of bring this down a little bit. But we're still in this uptrend for XOP, somewhere in this range here. And we're very cheap for OIH. OIH is the energy service companies. So what I'd be looking for is an energy service company outperformance at some point where we break that trend line to the downside. But we're still in an uptrend. XOP is still killing it. XOP versus GDX. And we had a nice little pattern here that basically squeezed up into this corner here. We'll look at logarithmic. You can see how it kind of squeezed up all the way to the corner there. October, November of 2020 would have been the spot to get in to XOP, which is where I entered with a lot of my companies. Now we're moving on higher. It's about average, kind of middle of the valuation with these two. But the momentum goes towards XOP, where we could continue to move higher. But you know, gold, silver, the overall markets there in precious metals look pretty solid. So we could have a race here where oil and gold go at it against each other. Looking at XOP versus crude oil, XOP is outperforming. We've seen this on Twitter and some of these other areas where they say, look, there's a divergence between XOP and crude oil. But I don't think that's necessarily the thing to do because, you know, looking at this is kind of your average ratio there, and we're not even in the average ratio where oil typically trades against crude oil. That could also be one of the reasons could be that crude oil has moved up dramatically to the upside, and a lot of these companies have had hedges in place. They've been underperforming because of their hedges. Therefore, the underperformance in this ratio is basically validated because of the hedges they had in place. And crude oil moved up a lot faster in relationship to the profits of the companies. So I do think that there's going to be a re-rating as these hedges roll off. And I think that we are going to move higher somewhere in this zone at a minimum. So that's my opinions there. XOP versus copper ETF. Again, we're kind of in that average-ish type area. You know, I would say anything in this type of area through here is kind of average-ish. This is overvalued land. This is undervalued land. When you're up here, COPX would be a good one to be buying, especially at this tip. We come on down, then you want to swap into your XOP, yeah, you know me, and then we head back on higher. So that's that. Looking at the energy service companies, OIH versus MOO, this is definitely favor of OIH. So OIH is cheap to MOO, OIH is cheap to XOP, and OIH is cheap to URNM. So OIH is cheap to basically everything. OIH is cheap to REMX. It's broken the downtrend line. This looks very good for an outperformance of OIX or OIH. And OIH actually, I think, is a good spot to be looking for specific individual companies. You also have what looks to be a shoulder, head, shoulder almost, inverted head and shoulders. I see that pattern a lot in the individual companies as well. So OIH is also one that looks quite good and quite cheap. Looking pretty tasty. GDX to gold ratio, this thing is really cheap for GDX when you compare it to its underlying commodity that it sells. I think it looks good down here for GDX. Very cheap in relationship to history. GDX versus REMX. GDX looks like it's ready to rip it, and it's cheap. So this looks really good for GDX and where it's located against rare earth metals. So I would be looking for particular companies, either specific companies in GDX or the ETF itself. GDX versus SILJ. When you're up high against this, it's usually favorable for the denominator. So SILJ is actually cheap to GDX. So GDX was cheap to a bunch of other things. SILJ is cheap to GDX. Therefore, SILJ could be a potential one to look at. It's probably going to lag behind. So you might see this come up, and then it's going to just rocket lower, much like this section here. So the way that you'd want to play this is if you get to these upper levels up here, you have to cost average in. You don't try to pick the top. You just cost average, cost average, cost average for 3 months straight here. And then you ride it on down. And when it starts to pop and break that downtrend line, it's a time to just say, you know what, it's done. It's consolidating. We're going to head higher. This would be a tough one. What I think's happening is we're going to see this do that. That is what I think it's going to do. And SILJ would be one to be looking at and looking for potential investments soon. Now, looking at copper versus OIH, as we were up here, copper's expensive, OIH is cheap, and we are heading lower, which means OIH or the energy service companies could potentially outperform. Down in 2016, copper was very cheap. That would have been the time to buy it, at least with these two ratios. Copper versus GDX. So copper's expensive to GDX. And this is where I would be choosing GDX. And I threw in TAN as well. We could look at TAN. TAN versus GDX. Basically, TAN is so volatile, it overpowers GDX's pattern almost. So this looks good for a potential move for TAN, but it's basically fairly valued given what it looks like. TAN versus XOP. So when it's up here, this is where you want to be loading into XOP as you go down. And then TAN becomes cheap as we come back to this level somewhere in this range down here. We're getting close to TAN being cheap. This could obviously reverse at any second. So TAN is probably favorable in this mix against XOP. TAN versus COPX. COPX is cheap in relationship to TAN, and we could potentially see a downward movement continue with that. And it doesn't mean that it has to happen immediately. We could go up, and then eventually it rips lower. We could go way up and then rip lower. But eventually, with time, I think that COPX is cheap, and it will work its way lower. Looking at TAN versus uranium, this guy looks absolutely wonderful for actually TAN to rip higher. So TAN is cheap to URNM, given this very short, small area here that we have for data, but TAN looks good to move higher against URNM. And URNM looked good to beat everything else, which means TAN could still move higher. TAN versus OIH, and we've got this gigantic pattern. OIH is cheap. It's been outperforming on this way down, but we'll see if that outperformance can continue or if TAN wants to rip it here. It's kind of fairly valued when looking at history with as little data as we have. TAN looks like it's ready to rip it against REMX and move higher, so TAN could outperform. And then we also have TAN versus MU. This is cheap for TAN. So we've got a nice outperformance of MU up here, TAN's cheap down here, and I think this looks good for a performance of TAN to break higher. So of these, to kind of look at and see which ones are cheap and what I'd be looking at, uranium looks pretty good, URNM. TAN looks pretty good for an ETF, and then I think OIH is also pretty cheap. Those are the ones that stick out to me as being cheap sectors. Those are ones that we are looking at and actively looking for individual companies that look really good for the Platinum membership. So if you guys want to join, definitely become a Platinum member at the finding-value.com. If you guys like the information here, give me a thumbs up. And don't forget to click subscribe to the channel so you guys can track all these different sectors with me. And I'll go over this every once in a while, kind of look to see what sectors look the best. And then I'm going to dive in with the website and get you guys what I think are some of the best companies. All right, guys, that's all I've got. We'll catch you later. This is Finding Value.